Here is the paradox that opens the whole issue. The American stock market just booked its best quarter since 2020. The S&P 500 rose almost 15%, and the Russell 2000 hit a record. And yet, under the surface, that same market has split in two. In the 3 weeks since its June 2nd record, the S&P is down about 3%, and the Nasdaq about 5%, as investors sold the artificial intelligence leaders. Strategists now call it two asset classes: artificial intelligence and everything else. And into that split came the biggest single move of the year. Meta jumped about 10%, adding roughly $140 billion of market value in a single day, on a report that it may sell its excess artificial intelligence compute as a cloud business. Think about what that does. The most questioned cost in all of technology, the hundreds of billions the giants are spending on artificial intelligence, was just recast in one headline from a cost into a product. The machine that builds could start selling what it builds. So where is the edge? Not in the crowd that paid $140 billion in a day for a promise, because the Federal Reserve just turned. At the European Central Bank's forum in Sintra, the new chair, Kevin Warsh, said plainly that prices are too high and that the Fed will decide on rates in 4 weeks, with markets now pricing a hike. The discipline is to own the machine that funds itself, the present tense cash flow the world is short of, and to price anything sellable. Any premium or promise as an option to be proven. This is the asymmetric. This is the asymmetric, issue 33, the sellable machine, tech and crypto investing for thoughtful retail from an operator's lens. Last issue named the fracture under a record index. This issue names what the crowd is doing about it and where the real turn is. A record quarter that is really two markets, a Federal Reserve chair openly weighing a hike, and a headline that made artificial intelligence spending a product. Here is the one-line read. The second quarter was a melt-up. The S&P 500 gained almost 15%, its best quarter since 2020. The Dow closed at a record, and the Russell 2000 hit a record. Yet the last 3 weeks told the real story. Since the June 2nd record, the S&P is down about 3% and the Nasdaq about 5%, as investors sold the artificial intelligence leaders. Strategists now call it two asset classes. The macro master variable turned hawkish. At the European Central Bank's Sintra forum, Federal Reserve Chair Kevin Warsh said prices are too high and that the Fed decides on rates in 4 weeks, with markets pricing at least one hike this year. The Drain agreed. Gold slipped below $4,000 to an 8-month low. The 10-year Treasury sat near 4.45%, and Bitcoin traded near 58,000, testing its 200-week line after the worst month of fund outflows on record. Into that regime, Meta jumped about 10%, roughly $140 billion in a day, on a report it may sell its excess artificial intelligence compute as a cloud business. You'll see the same labels throughout: confidence, high, medium, or low, consensus versus variant, what the market believes and where we may differ, and on every call, what would change our mind. That's the discipline. Part 1, the macro regime, a record quarter, two markets, and a hawkish turn. The 30-second frame. 1. The quarter was the best since 2020, the S&P up almost 15%, the Dow and the Russell 2000 at records. 2. But it is two markets. The S&P is down about 3% and the Nasdaq about 5% in the 3 weeks since the June 2nd record, as the artificial intelligence leaders sold off. 3. The Fed turned hawkish. Chair Kevin Warsh said prices are too high and the Fed decides in 4 weeks, with markets pricing a hike. 4. The Drain confirms it. Gold slipped below $4,000. The 10-year sat near 4.45% and Bitcoin traded near 58,000 at its 200-week line. And 5. The ease tail is the bid. United States and Iran talks resumed, and oil drifted near $69, even as the American oil reserve sits at its lowest since 1983. Start with the paradox. The second quarter was the best since 2020. The S&P 500 gained almost 15%, the Dow closed at a record, and the Russell 2000 hit a record, up about 21% as small companies finally joined. On the surface, a genuine melt-up, but under the surface, it is two markets. In the 3 weeks since the June 2nd record, the S&P is down about 3% and the Nasdaq about 5%. And the selling was concentrated in the artificial intelligence and semiconductor leaders. Strategists now describe the market as two asset classes: artificial intelligence and everything else. The index level holds only because breadth, small companies, the non-artificial intelligence names, is catching up even as the leaders correct. The consensus says buy the dip in the leaders. Our variant own the split deliberately, because a broad index buyer now owns both the melt-up and the drawdown at once. Now the turn, and it is the master variable of this issue. For a year, retail has been positioned for rate cuts, but at the European Central Bank's forum in Sintra, the new Federal Reserve Chair, Kevin Warsh, leaned the other way. He said inflation remains too high. In his words, we've all looked around, and we've seen that prices are too high and that policymakers will decide on rates in 4 weeks without pre-committing. Markets are now pricing at least one hike this year, and the European Central Bank itself raised in June. Warsh even flagged that the artificial intelligence shock is leading to a boom in capital spending, with huge implications for monetary policy, the chipflation loop from the chair's own mouth. The consensus says the next move is a cut. Our variant, the near-term risk is a hike or a hawkish hold. The chair reacts to the print, not the forecast, and the cross-asset tape, gold below 4,000. The 10-year near 4.45 is already trading it. Macro 3, the drain and the ease tail. Gold, rates and crypto tell one message: the price of money is high and the Fed just signaled it may go higher. Gold slipped below $4,000 to its lowest in about 8 months, pressured by high real yields and a firm dollar, cited by level and driver, never a contested return. Gold's record was in January, not today. The 10-year Treasury sat near 4.45%, and Bitcoin traded near 58,000, testing its 200-week moving average near 61,000, a level that has historically marked cycle bottoms, but only after the worst month of fund outflows on record, about $4 billion in June. The one offset is the ease tail. United States and Iran talks resumed, and crude drifted near $69, even though the American oil reserve is at its lowest since 1983 and the Strait of Hormuz remains disrupted. A de-escalating price on a drained buffer. The downside is gradual, but a breakdown would reprice everything instantly, straight into a chair who already says prices are too high. Part 2, in focus, the machine that funds itself may start selling what it builds. The in focus name is Meta, and one headline recast artificial intelligence spending from a cost into a product. On July 1st, Bloomberg reported that Meta is weighing selling its excess artificial intelligence compute through a cloud business, and the stock jumped about 10%, adding roughly $140 billion of market value in a single session, its sharpest one-day move of the year, to about $1.5 trillion. The report describes two paths: hosting artificial intelligence models for outside developers and renting raw compute as a neocloud, either of which would put Meta head-to-head with Amazon, Microsoft, and Google. From Meta's own filings, the scale of the machine is enormous. Fiscal 2025 revenue of $201 billion, net income of $60 billion at about a 30% margin, while spending roughly $70 billion a year on artificial intelligence infrastructure. So the report, if real, turns the most scrutinized cost in technology into a revenue line. But it is unconfirmed. Meta has not verified it. Now the mechanism, how a cost line becomes a product line stage by stage. Stage 1, the machine funds itself. Meta's core advertising business throws off about $60 billion of net income a year at roughly 30% margins, present tense cash, from a founder-controlled allocator. That is the scarce, self-funding asset, and it does not depend on a premium. Stage 2, it builds at enormous scale. That cash funds an artificial intelligence build-out running above $75 billion a year, the most questioned line item in technology, because the market has spent 2 years worried about the return on all that capital. Stage 3, so it sells the excess. If Meta rents the spare capacity as a cloud, the return question inverts. From when does it pay off to it's already a product? But here is the asymmetry. The market paid $140 billion for that promise in a day, and the promise is unconfirmed. Selling excess capacity can also mean the build ran ahead of demand, overbuild. The cash is the machine, the sellable part is a call option. Debate, the bull, capex finally gets a number. A cloud business turns the most scrutinized cost line into a revenue line, signals that Meta's own utilization is high enough to have capacity to spare, and layers a potentially high-margin, recurring stream on an engine that already prints $60 billion a year. If Meta can rent even a slice of a $75 billion build, the return debate is over. The bear: it is a promise, not a business, and maybe a tell. The report is unconfirmed. Selling excess capacity cuts both ways. A firm truly short of compute for its own ambitions would have none to spare, so the pivot can signal overbuild. Cloud is brutal, capital-intensive, lower margin than advertising, and dominated by three incumbents a decade ahead. And the category Meta would enter is fragile. The listed neoclouds, CoreWeave and Nebius, fell about 12% on the very same headline. The referee is whether Meta confirms it, with real customers, revenue, and margins. The read: a research view, not a call. Meta is this issue's spine in one name. The self-funding, present-tense side is the advertising engine, $201 billion of revenue, $60 billion of net income, roughly 30% margins, a founder-controlled allocator. The premium and promise side is everything: the $140 billion move paid forward, an unconfirmed cloud pivot, at unproven margins, into a category its own arrival made less profitable. The discipline is not to fade Meta, it is to anchor on the machine's cash, and to size the cloud optionality as a call, not a certainty. What would change the read? Meta officially confirms a cloud business, with named customers and disclosed revenue at credible margins. The promise becomes a machine, versus Meta denies it, or the $140 billion pop retraces, or it enters into margin-denting price competition. Step back to the dividing line, the machine that funds itself versus the premium on a promise. In a hawkish two-market tape, present-tense cash flow gets paid, and promises get discounted, which is exactly why the $140 billion Meta paid for an unconfirmed cloud plan is the kind of premium a hardline Fed pressures if the story doesn't convert. So own the machine, Meta's advertising engine, the sold-out memory input, the self-funding hyperscaler. Scarce baseload power, cash the world is short of today. Price the promise as an option, the neocloud pivot, the crypto high beta tail at its 200-week line, gold's pinned haven bid. And note the policy tailwind: the United States lifted its export curbs on Anthropic's Fable 5 and Mythos 5 models, choosing artificial intelligence leadership, a bullish signal for the whole American stack. And the thematic: own the self-funding machine and price the promise as an option. Own the self-funding cash machine, Meta's advertising engine at $60 billion a year, and the hyperscaler that funds the biggest build on Earth from operating cash. Own the scarce, sold-out input, the memory bottleneck with contracted demand, scarce baseload power, and the durable margin software compounder. Own the rails and the absorber, the cash-generative tokenization rails, and the toll collector that earns on crypto either way, with the policy tailwind of the United States clearing Anthropic's models for export. And price as an option, the premium and promise complex, Meta's unconfirmed neocloud, the crypto tail at its 200-week line after a record outflow month, and gold's haven bid pinned by the hawkish turn. The discipline is not sell tech or sell crypto. It is own the machine and make the promise prove itself. Part 3, the read: own the machine and make the promise prove itself. What we are watching over the next 10 days. The United States jobs report on Thursday, the week's pivot into the Fed's 4 weeks. Chair Warsh's first rate decision, a live hike versus hold, whether Meta confirms or denies the cloud plan, which turns the $140 billion promise into a business, or retraces it. The next inflation print, with memory-driven chipflation embedded in it. Bitcoin's 200-week line and daily fund flows. Gold against $4,000 and the 10-year near 4.45. The July 3rd and 4th holiday with a thin liquidity yen intervention window. Market breadth, artificial intelligence versus everything else. Oil against Hormuz with the reserve at a 1983 low, and CoreWeave and Nebius as the neocloud tell. And we keep score in public. Meta enters new own the machine, price the cloud pivot as an option. The macro theme, the Fed, a live hike versus hold debate, not a cut. The market theme, 2 asset classes, the split between artificial intelligence and everything else. Crypto updated, a liquidity drain rotation, not an impairment. And carried forward, Micron, the sold-out memory bottleneck, Alphabet, the self-funding compounder, strategy. The inverted premium wrapper, the cautionary mirror of Meta's self-funding machine, BlackRock, the toll collector, and gold, cited by Level and Driver, and below $4,000, not a record. Dated, falsifiable calls, and we grade them. So where does it land? The best quarter since 2020 closed as two markets, and the Fed chair leaned into the hawkish side. The S&P gained almost 15%, with the Dow and the Russell 2000 at records, yet the last 3 weeks were an artificial intelligence-led drawdown inside that record. Strategists now call it plainly, two asset classes. At Sintra, Kevin Warsh said prices are too high, and the Fed decides in 4 weeks. With markets pricing a hike, and the drain agreed, gold below 4,000, the 10-year near 4.45, Bitcoin at its 200-week line. And Meta made artificial intelligence spending sellable, jumping about 10%, $140 billion in a day. On a report it may sell its excess compute. It is both sides at once. A self-funding machine that earns $60 billion a year own that, and a $140 billion promise built on an unconfirmed pivot price that has an option. The crowd paid for the promise in a day. The evidence says own the machine and make the promise prove itself. This is research, not personalized advice. Verify it yourself. We'll see you in the next issue.